Okay, hey everybody, Dan Fitzpatrick here, stockmarketmentor.com. Market closed about 40 minutes ago, and I just wanted to share something with you about a post or a market comment or call, whatever you want to call it, that I issued to our members about just, I don't know, I should have issued it earlier, but it was about 10 or 15 minutes before the market closed. And my suggestion is that if you're looking for not just a hedge, but even kind of a directional thing in a heavy market like this, when you see the S&P come up to test the 200-day moving average and then roll over, fall away, that's kind of a big deal, particularly when volume was pretty heavy. And you could say, well, what do you mean heavy? Yeah, relative to the 20-day moving average, it was pretty light. But relative to where it was yesterday on the one day, I guess you could look at this day too, but I'm not. On the one day that this popped up and closed above the 200-day moving average, fact that this was higher volume here, and it's Wednesday, it's not like it's a Friday expiration. This really means something, and it tells me that there's just not a lot of buying interest at this level, which would be understandable. I mean, that's why they say when a stock approaches the 200-day moving average from below, that 200-day moving average is likely to be resistance, at least for a while. When the stock approaches the 200-day moving average from above, it's likely to be support, at least for a while. And by the way, as I just mentioned, that if the 200-day does not act as support and instead the S&P in this case just keeps going, that tells you something. It didn't break nobody did anything bad. It's just that when something does not act the way it's supposed to, you need to take notice of that. It's different. But as I'm looking at the S&P now, this is actually acting really the way you would expect it to. So this is something where you could be shorting the S&P and you'd put in a buy stop, like buy to cover your oh crap level right up there. So it'd be, you'd be taking a real small risk on a short like this. And if you're not used to shorting stocks, it might be a good experience for you. And then on the other side, literally on the other side, you flip it upside down and add some leverage. And we've got the SDS, the ultra short S&P 500. Liquidity is not an issue. You can see there's almost 10 million traded today, and this was high volume relative to the last week or so, but low volume relative to the moving averages. And so this would be another one where you could be looking at this as and by the way, this trades off of the S&P. So I'm not really looking too much at the 200. I mean, you pay attention to it, but I'm not really looking too much at the 200-day moving average here. I'm looking at it here. Okay, so just had to mention that because it's pretty glaring here. So on this one, you would be buying the stock and then putting in a stop order, a stop loss order right here. So once again, you've got a low risk entry, and this could make some serious money if we get more of a pullback. Okay. And then the other thing that I'd mention was on the Qs. QQQs, we get again like a little bang up against the ceiling and then a move higher, lousy close, high volume. Or you could also do the QID, similar to the SDS. Gap down today, just like the S&P gapped up and then, or the NASDAQ gapped up and then immediately pulled back. So this is rallying. And where are you putting your stop loss? You are putting your stop loss right here. Okay. So these are 4 potential trades for you if you are inclined to go on the short side. Most people do not short stocks, but every so often it turns out to be kind of a good thing to do. And this is one of those times. So, okay, that's all I got for you. Members, I did a live strategy session just a little bit ago. If you didn't catch that, it'll be out pretty soon. All right, talk to you guys later. Have a great evening.